Yes, good afternoon. I'm Evan Simonoff, editor-in-chief of Financial Advisor magazine, and we're pleased to have you here at a session entitled "A New Playing Field for Long-Short Hedge Funds." We've lived through a very volatile 21 months or so. You might have said the months before that were volatile, but asset classes were going straight up, so the public doesn't consider that volatility back in 2021 anyway. We've got a great panel of long-short managers for you here today. Ali Motammed is the founder and managing partner of Invonomic Capital Management. Prior to founding Invonomic, he was portfolio manager of the Boston Partners Long Short Equity Fund. He was named the alternatives category Morningstar Manager of the Year. I'm sure he will have a lot of interesting thoughts to share with us today. Tom Hayes is founder and chairman of Great Hill Capital. Tom worked at Cornwall Capital before starting Great Hill. He's publishes a weekly timely commentary, and he has kind of a quality value bias, but we'll let him discuss that more. And finally, we're lucky to have David Lundgren of Little Harbor Advisors, and he worked at Wellington for years, and he is something of a momentum guy. Again, we'll let him discuss that. He was the head of technical research at Wellington Management, and he was a managing director, portfolio manager with extensive management experience in global. And I will tell you that he is the only one on this call today who is not in Europe. So before we start, was just warned to alert everybody that at 2:20, FEMA is scheduled to do some kind of national alert. So if your computer starts blaring or your cell phone starts jumping and dancing around, that's you'll know what that is. It's just a test. I don't know if it's the emergency broadcasting system or FEMA or who, but it's a test. Anyway, let's get started. The low interest rate environment of the last 15 years was very favorable to long duration assets. That included everything from bonds to growth stocks. It also challenged many value strategies. It was a tough environment for a lot of alternative investments when your stocks and bonds were basically going vertical. And 18 months ago, everything changed dramatically. So my question, I'll start with Ali. How has the advent of inflation and a new central bank regime influenced your investment strategy since January of 2022?
I mean, I think we look at where we are right now, and you're looking at 15-year government bonds in the 5.1 to 2 range. And I think that's something that most of us didn't anticipate a little while ago. I think when you look at the margin that banks need in order to be able to facilitate their underwriting, credit risk, and you combine that, you're looking at a 8 to 10% minimum rate for financing assets over a 15-year duration in this country. That's generally been one of the lower rate durations. And I don't think that corporate America is ready to handle that by any stretch. Now, I do think that, the United States can handle it. And I think that when we look at the opportunities that we have, considering that we didn't anticipate that one, and we're sitting here and we're sort of in a good position, I think that those are unique opportunities to be able to participate and buy certain instruments that we never thought we would have a chance to at yields that are much higher than we have anticipated. So I think, it sets us up a little bit differently than it did before. I think funding matters a lot more. I think we look at balance sheets a lot more carefully, making sure that our companies are durable and will be able to be there if we have a recession or not, to come out of the other side of it.
Okay. Tom, what are your take on how you've navigated the 20 or so months?
Well, we like to buy straw hats in the winter. So whatever the macro serves up to us is kind of immaterial in that the asset classes that will become attractive to us as a function of the macro that happen to be served up will present themselves. Okay, so if you think about during the COVID 2020 was a completely different environment from 2021 and 2022. So during COVID, when oil went negative, no one wanted energy stocks. We bought the highest quality energy assets. We bought the highest quality banks that were trading at 50% discount to book. Last fall, after long duration assets got absolutely smashed and everyone thought Google was toast because OpenAI was going to eat their lunch and Bard was a failure because they had a bad launch show. We picked up assets like that. We picked up businesses with moats like Amazon. We picked up semiconductors when they were left for dead. And the most hated of all during that period of left for dead was Intel, which was a bag of garbage that you couldn't give away with your neighbor's purse. That's the type of stuff that we get very interested in. So we try to spend less time on macro and more time on buying durable, sustainable cash flows when they're temporarily out of favor. We profit from periods of dislocation, and the macro is kind of the cause, but the opportunity set that shows up is what hits our screens, hits our attention, and then we can do the diligence work on the balance sheet, cash flows, return on invested capital, and find opportunity that way.
And David, you're a momentum investor. The momentum hasn't been I guess earlier this year it was favorable for about 6-7 months, but it's been volatile. What's your take on the current environment?
Well, I mean, starting with the perspective of rates, I mean, since really the late 90s, rising interest rates have actually generally been good for stocks as opposed to the environment before that. And that was true right up until the very beginning when rates just came off the bottom more recently. That was actually supportive for equities as well. But I think that once you got past a certain boundary on the upside, that's when it really started to come unglued. And that actually started at the beginning of 22. So that relationship could have finally, after almost 20 years of, or maybe more than 20 years of the relationship that we've had, where we're kind of stepping back from or trying to battle with deflation. So every time we had rising rates, that was a good thing. We may have turned the corner and we now are facing an inflationary environment. So things are normalizing, which in many ways could be a good thing, but also moving from one regime to the next can be a painful process. And I would say when you look at the market, the inclination is to say that we've had a really good run off since the start of the year. But if you actually look at what the average stock has done, we're actually negative on the year. So that's more in keeping with what a portfolio manager would experience as opposed to somebody who's buying and selling or trading index futures, or maybe as a passive long only investor. Portfolio managers who are active managers, sort of in the weeds, trying to pick stocks that outperform over time, have really been fishing in a pond that's more of a swamp these past 2 years than a nice vibrant pond full of great ideas.
Okay, do you expect a U.S. recession in the next year?
I mean, I try not to forecast the unforecastable. I think people that are really good at it aren't very good at it. So I know where to kind of like draw the line and spend my time. But what I do find interesting is that I think we all can agree that payroll data is a lagging indicator. And maybe some of the folks on the call with us today can help flesh this out. But I'm just surprised that the strength of the payroll data is getting such airtime as it being, why is this not coming in? That suggesting that there'll be no recession when it's a lagging indicator to begin with. So I don't get too caught up on it, but I am kind of interested to hear what these guys might think about the payroll data, and doesn't matter that it's quote unquote so strong.
Yeah, Ali, a lot of the smartest guys out there, Jeremy Grantham, Jeffrey Gunlock, all these guys have been saying a recession's coming. You have any sense, or are you?
I mean, if you told me what our political system would do, I could tell you if a recession is coming, because if you're going to hand out huge amounts of money to American citizens, you will stave off any recession you want, at least for some period in time. You also create inflationary outcomes. So we're facing a situation where we have huge deficits, and I don't know how we're going to go about fixing some of those, but I think they are what's contributing to the not having a recession. And I worry that they're not sustainable with financing rates for our U.S. government at the points that they are. And so it gets a little bit more difficult, at some point, as we get our budget in a row, tightened up, we're going to have a recession. And so I think that that's a little bit problematic.
Okay, Tom, your sense is?
The thing you learn early on in this business is never call both price and time in the same call. Yeah, I guarantee you we're going to have a recession. I just can't tell you when. More likely than not, it's a lot further out than most people anticipate is kind of our framework at the moment. And our view is constructed from the fact, among other things, that we did have a technical recession last year of 2 quarters of negative GDP growth. And despite the contraction in M2 money supply, we are running $3 trillion above trend, the long-term trend line, and that's going to take a lot of time to absorb that. So while Ali makes a point about bond yields and refinancing the debt, I think that what you have with global coordinated central banks is what you saw last fall when the Bank of Japan intervened to strengthen their currency. And that marked the bottom in the stock market. It marked the top in the dollar. And yields began to compress from that point on. You saw a rally in emerging markets that was very abrupt for 3 or 4 months. You saw a rally in equities that took a lot of people by shock. Some of the biggest names that you referred to when the market was down 25%, were calling for another 20%. And consensus at that point was that earnings were going to fall another 20%. And instead, from that point, earnings revisions have continued to go up. So, and then lastly, besides M2 money supply, besides the fact that we had the technical recession that everyone's waiting for, is the fact that you have the largest segment of our population in their early 30s, namely the millennials, and historically that drives consumption, that drives growth. Housing formation is the key, and it's very difficult to have a weak economy when you have that many people in their early 30s.
So this is demographically somewhat similar to the 80s, or?
Yeah, I mean, if you backdate the math, you're at about the early 90s. You're about kind of midway through a cycle. But again, it doesn't sound like it, but we spend less time, or actually assign less weight. We spend the time, but we don't assign the weight to macro predictions and all of that. We look at durable, sustainable cash flows that are temporarily out of favor that we can buy at a reasonable price.
Okay, well, speaking of being out of favor, Tom, you and Ali are in Europe, which for a long time we've been writing. A lot of other people have been saying that there's a lot of value in Europe. It's out of favor. They may not have great demographics, but they do have quite a few cheap stocks. What's your sense of Europe and the world beyond America in terms of, I mean, one of these days they're going to outperform probably for a little while.
I mean, I'm happy to go first. I think one of the difficult things is that, Europe is very similar to the United States in its characteristics. And so, while it is a different country and they speak, or area, and they speak a different language, they have a lot of the same issues we have. And so you're not really creating a great sense of diversification. by investing in Europe necessarily. You've got similar issues to the ones you do in the United States. There's a expanded group of companies, which gives you an opportunity to be a little more selective in what you choose to buy. But obviously we have some element of capital controls in place that limit our ability to invest in more of the commodity producing countries of the world, which would perhaps provide some element of an offset, and we respect those and kind of go with it as we can. And I think that from our perspective, we are a little bit less optimistic on both sides, Europe and the United States, than many of our peers. And we probably think the recession is, outside of the political landscape, a little easier to call than perhaps other people may think.
Yeah,
And
I think, Evan, part of the reason that people perceive European stocks to be so much cheaper than the US is because of the weighting of different sectors. So if you back out the Magnificent Seven, which is the heaviest weights in the S&P 500, the forward multiple goes sub 15 versus close to 20. So that makes our multiple look a lot less expensive. And you just don't have high growth tech behemoths in the European indices. They're weighted by pharma. They're weighted by, in particular, financials, which carry low multiples. So I think you have to take it on an apples to apples basis. I think the better play in terms of undervalued with growth, with positive demographics, with abject pessimism and untouchability or uninvestability right now is emerging markets. And I think to have that view, you have to have a view of some sort that the rout in bonds is nearly over and there will be a bid in the middle to long end of the curve in the intermediate term. And as such, the dollar's counter trend rally is nearing the end versus the beginning. And if you carry those two views, which we do, then you can start to look at, on a company by company basis, high quality businesses in those markets where there's a lot of geopolitical risk already priced into the multiples, because that's the initial argument. I love the argument, the anti-China argument, which is what if they invade Taiwan? Well, if they invade Taiwan, your apple's cut in half, and so is the S&P. So what else do you want to talk about? So I think that the world is flush with opportunities, but I think in terms of versus a macro basis, I would look on a company by company basis. Is the free cash flow increasing consistently? Is the multiple contracting or expanding? And how does that multiple look relative to its historical range and adjusted for the increased cost of capital, which Ali referenced earlier?
And I think a sector in the US that would be particularly exciting or interesting, at least right now, is utilities. If you share those views, because you do have a lot of that rate sensitivity. Effectively, they're somewhat proxies with somewhat of a different funding structure for US government debt. So, I would encourage the investor group to, if they're going to pay attention to a sector in the United States, that's one that might be interesting. And you do have energy sort of renaissance, I guess, in the way they want to deliver energy, that's going to lead to infrastructure investment, particularly in the T&D side. We're finding a lot of great assets in that area. So again, when we talk to people, it's about trying to take these times, rather than to be a hero, but to establish balance in your portfolio and resilience, so that would be a chance right now where maybe we didn't have a chance to go buy the 5.2 govy debt a couple years ago, or the utility trading at 13 times and 1.5 times plant, but we do now. So we can constantly improve the quality of the portfolio, and a way to do it in the US without risk to any sort of investing in any other countries that might not be politically favorable, is to just participate in US utilities.
I'd have to just, to put a bow tie on that, because it was, kind of feeding off of what we laid out. I agree with Ali on the utilities. I think it's a contrarian trade with a high margin of safety at these valuations. In that context, which you'll probably disagree on this side, but they trade similarly, or maybe he won't, maybe he'll agree, is selectively on the REITs, all the interest rate sensitive stuff that's been left for dead. And actually, people are waiting for a steepening of the yield curve to buy banks, and that's actually not what's driving the bank trade right now. What's driving the bank trade is mark to market. So if he's right about utilities, it means the route in bonds has stopped. It doesn't necessarily mean it's reversed, but it's definitely stopped or slowed. And if that's true, then you've got some opportunities on a discrete basis in REITs. But I think more importantly, in banks, in terms of impressive outcomes, the amount of embedded value in some of even the money center banks, but even some of the selected regional banks, that if the balance sheets started to look more durable, they'd get bid hard and they'd get bid aggressively. So it's all tied into the same. You have to have that view, whether you're thinking utilities, whether you're thinking REITs selectively, or you're thinking banks at the moment.
David, what's your view of the market opportunity set facing investors now and over the next 1 to 3 years? Where do you see some of the biggest opportunities and some of the biggest red flags?
Well, I think my answer to this is very likely going to highlight some of the differences in how the three of us invest. Where I think if you're thinking of buying banks because they're down quite a bit and they're cheap, which is something I'm not qualified to speak to, but I do know that if you just step back and look at the big picture on banks, they've been sort of an underperforming sector within the market since 2004, 2005. So that's quite a long time of underperformance. And so the latest bank crisis that we're having is just another, there's your alert coming in, is just another chapter in the ongoing saga of bank underperformance. And to Ali's point, I think it was Ali that mentioned it, that that's largely why European equity indices have performed so poorly, because they're so laden with financials and other inflation sensitive assets. So I'm a lot less inclined to focus on utilities and REITs and banks, because they just haven't been the best performing sectors for quite a while. And so what I'm looking to do is, like, if you think about how I invest, I'm more in the mold of like a William O'Neill, where it's trying to find strong growth companies with positive momentum and trend and things like that. And unfortunately, while there have been some decent setups and opportunities over the past, say, 21 months, I mean, there really hasn't been. I mean, we're still paying the piper from the growth bubble that we went through in 21, and it's it kind of peaked out in the late 21, early 22, and that's kind of that's the environment that I've been kind of dealing with as an investor in my process since then. I do go short as a hedge fund. I do go short, but I only explicitly short during down phases in a bear market. So we had a decent year last year, but this year it's more like, as you said, it's almost like 20 months of overlapping sideways price structure with growth paying the piper from the previous bubble. For me, it's just been a hunker down and wait for things to settle down before you can really identify the next true leadership.
If I may, on banks and REITs, we're a little more selective. I mean, we're not really as bullish as we may be on some of the utility type names, but we are definitely interested in doing the work to be ready for when the opportunity comes, because coming out of the back end of this, there may be a very nice one. It's just that we think going in on some of them, there's a little bit more risk than perhaps people perceive. And so we would rather be a little more neutral and spend our time doing the work and picking our moments.
Tom, your thoughts on some of these?
On banks, REITs, and utilities, or on
and other opportunities, potential opportunities? Or
I think that the bigger surprise this year, the end of this year into next year, is going to be that bonds get bid. And we say that for a number of reasons, whether it's coordinated central bank intervention, the amount of debt outstanding, The amount of, one of the data points that we look at among hundreds is the commitments of traders report with hedge funds record short. The last time you saw large speculators this short 10-year note was the bottom in 2018, which, like right now, ironically, you had an overshoot of the low where all the technicians came in and said, oh, it just made a lower low, therefore you should short it in the hole. And what happens is often when everyone's already on that boat, as evidenced by the data and the positioning, there are no marginal sellers left. I also think that you're going to see material pension demand step in before the end of the year to lock in long dated assets at 4.5+% to match their long dated liabilities. Few people are really paying attention to the supply and demand on that side. And I think more likely than not, you're going to see the Bank of Japan step in to defend its currency, which is going to have knock-on effects. So in that context of a weaker dollar and stronger bonds, which maybe Ali will agree modestly on these 2 points, but it doesn't really matter about the view. I just look at where are the opportunity sets, and then where can we find strong enough balance sheets where we're willing to wait, because ultimately we're in the time arbitrage business. So when the markets get dislocated, we don't really pay a ton of attention to price. What we pay attention to is the earning power and future prospects of this business impaired on the basis of what's causing the dislocation in global markets, or is it improved, or is it steady? And if it's steady or impaired and it's marked down 15% because of some seasonal volatility or some funds got caught sideways and create some deleveraging in the system, we'll just look to see whether we have availability to scale up in a position that we know has great long-term prospects. And I think that when I think about where we are now, given that framework, I think certainly some utilities, I think certainly some REITs, I think certainly some banks. I think if you take the view that the dollar counter trend strength is nearing an end, then you want to be in multinationals that have greater than 50% of their revenues abroad. And you want to have some exposure to emerging markets. And you can get that directly or you can get it indirectly. So what are two major companies that have been smashed, which we don't own because of China fear? Nike is one of them, high quality, durable business. And Starbucks is another one that both have largely been smashed on fear of China growth expectations. China is so bad, they're going to grow 5% this year. And it's mind-boggling when you think about it. The amount of aversion because of perceived and real geopolitical risk and policy risk, which has been less than desirable, to put it mildly. But it's like the old saying, meet the new boss, same as the old boss. This is kind of the same boss of the last 10 years where you had huge runs. And when the dollar weakened, they got the flows. And when the dollar was strong, the flows came out of emerging markets. And this time will be no different. But if you can make a compelling case that the dollar is going to continue to strengthen, then that thesis is null and void. We're just taking the other side.
If you get a bond bid, which you may be quite right, like you're going to, and you didn't buy your 5.2 and your 5% bonds for your clients. Look, everybody here is out to serve a purpose of living a life, right? If you're getting an opportunity to go buy U.S. government debt and lock in rates that are higher than you ever thought you would within a reasonable context to be able to achieve your goals, and you don't do it, I think it's not a good idea. I think you should do that. We all hear managing hedge funds, but I think that really when you look at what is outside, we've had the biggest move in rates in thousands of years off the bottom here, literally thousands of years. B of A did a study off the bottom. So if everybody runs out and they just get one thing to remember from this, that would be what I would say is, please just revisit your allocations. Think about what your goals are, and then, think of what's in front of you as an opportunity.
Yeah, and just to add on what Ali just said is he deals in thousands, I'll talk hundreds. This would be the first time in 250 years that bonds were negative 3 consecutive years in a row. I wouldn't make that bet. I know there are a lot of big names out there that are, shorting in the hole very aggressively and being very vocal about it. But, sometimes you have to keep in mind incentives, and the incentive may be getting out of a big position when it's aggressively being advertised that the route's going to continue. So keep in mind, what I can tell you is we spend a lot of time on positioning and sentiment in terms of the broader framework, kind of top down and then bottom up on a company by company basis. And positioning and sentiment are very important, and we're at extremes in emerging markets, in anything rate related, in all the utilities. That these are times where you can't pick the bottom, but if you know what you're buying and you know what you're owning, at the level of debt globally and the amount that has to be refinanced, the world won't work without some intervention. So, you can make the case we're going into the dark ages and short everything and go to cash. I would take the other side of that aggressively, and whether it happens naturally from demand or unnaturally from intervention, we're at the point where things can break again, and we're at the point where something will happen. Either demand will fill the gap or intervention will fill the gap, and that's going to be a regime change that very few people are positioned for over the next 12 to 36 months.
David, I know you're probably not a long-term bond expert, but would you tell your neighbors up there on the North Shore of Massachusetts, if they asked you for advice, to take a look at long-term treasuries? What Ali said is, I didn't think I'd see 4.9% again, in this decade, and that's what they're yielding. Just as a wise man in your town.
I think the choice you have is you can either just capture basically the same yield, or actually an even better yield, with a shorter dated note, and you have the benefit of continuing to see your yield go higher should yields go higher. Tom, I'm completely on the same page in terms of positioning and everything else. It's looks pretty extreme, but I'm not so sure that, like, when trend changes, it always does the most something that it's ever done in the moment that it changes. And so what I'm concerned about is that the degree to which we've come off the lows, the very fact that yields went negative. When you think about bubbles, the yield on a bond is the valuation, and yields were negative for $17 trillion in bonds during the past couple of years, and coming at the end of a 40-year downtrend in rates, that seems like a pretty auspicious way to end the bubble. And so if that was true, and I had this view that if that's true, we should see a violent move against that, just like we saw a violent move after the 99 bubble in equities. We just saw a crash. So the same thing happened to bonds. They crashed. And so I'm not sure that I'm comfortable saying that I would buy a 30-year bond here, because my concern is more that rates have changed their trend, and we've kind of unleashed the inflation genie out of the bottle, and it's going to be tough to get it back in.
Yeah, but I think you're correct in terms of whether you should or maybe your client should. I think if you're managing hundreds of billions of dollars of pension money and you have a 30-year liability, and your liability, you have to yield 4%, and you can lock in 4.5, 4.7, 4.9, and you don't do it, your career is going to be very short-lived. So I think there are other factors at play here. Now, if you're right, and we are going to persist higher, then you have to think in terms of, if we're not going into the apocalypse, what does the nominal growth rate have to be in an environment that can sustain 7, 8, 9% yields? And you'd have nominal growth, at some similar level of high single digits, i.e., effectively inflating that debt away. And in that environment, what type of businesses would do well? Businesses that can pass along price to customers and would absolutely mint money. And, you'd start to look for dislocation in those sectors showing up in a material way, and it's just not happening at the moment. So that may change, but it hasn't changed yet. So it doesn't forebode either a super high nominal growth environment that would support super high yields that could be refinanced at high yields in theory, And I, I'd be willing to take the apocalyptic view, except the world only ends once. And if the world ends, the last thing I'm going to be worried about is bond yields and real versus nominal terms. So so far so good on the world ending. But on a discrete basis, would I buy a 30-year bond? No. Would I consider a 10-year bond? I would want to express that view in better ways where I can benefit from the leverage of the balance sheet, i.e. utility, i.e. A discrete REIT, i.e. a bank who has mark-to-market issues that when it gets bid, you'll get a double because it's trading at a discount to book, and it's has a generally healthy cash flow profile, and relatively steady business. So, but I can definitely see your viewpoint. That's just how I would kind of frame it.
You get a double buying 14-year U.S. government debt right now with zero coupons or with low coupons. So that's that. First of all, the 30-year argument I think is an extreme. I'm not sold on the 30-year. I think David's right in the sense that when things go for 40 years one way, they turn around and they don't just go for a couple days the other way. They probably go a little longer. But I also think that our government is out to look for the people, and people will hurt in this environment. And if we have a rate perpetuation that keeps going, it's going to get damaging. You cannot finance a home at $420,000 median price at 10%, and then pay your other bills and only earn $70,000. You're going to have a lot of hurting citizens, and I think our government will do things to help those people. And I think that you will have what was a massive move that has happened in a relatively short time, being to some extent, normalized and made by our government into something that our citizens can handle. And maybe over the 30-year duration, the rates are right. But I think that over that midter term, and we're stock pickers, we don't do this stuff, but we just see what's out there, right? But I think over that midterm period, as they make the transition, you might have a nice chance to pick up some stability, some yield, balance your portfolio, and then have capital to redeploy in that weak moment.
Okay, well, Ali, as you've had some successful short sales in your career, very successful. Is there anything in particular that you were either short or considering?
Yeah, I would like to. The one thing I'll point out, the market's been up. I've been doing this 20-something years. I think we're barely break even short selling, right? So the idea that we've made money short selling, that's not what we do. We're trying to hedge and manage our exposures so that we have the opportunity to buy things when other people can't. So that's kind of how we look at it. And when I look at just short opportunities, I would say they're all over the place in the sense that, we have 4,000 companies in our universe that we look at. We're shorting, 100 to 200 of them, roughly speaking. And when you're trying to look at, 2 to 3% of the companies traded in the market and say perhaps those are well overvalued and going to go down and set us up as a good opportunity to protect capital for our investors, we have pretty good opportunity to do that. And our portfolio exposures right now are relatively low. So there isn't really anything I would, rush out and say, I do think it may be hard for people to pay for their house. Right. I do think when you've had defaults on loans being pushed off, so your first loan default's a student loan at 16%, and then the rates go down. And so when you think about it, if you don't have to pay your student loans, you don't default on your mortgage, you don't default on your car, you keep paying them until you default on your student loan, and then you default on everything at once. Right. And then also from a housing perspective, it just gets hard when you look at those rates. Right. So, I would be a little bit more concerned about those areas. But again, I think that, over the midterm to longer term, they will stabilize.
David or Tom, Ali is alluding to the housing, I guess you'd call it gridlock. people won't sell their house because they've got a 3% mortgage. And the only people buying are, as I understand it, just talking to real estate brokers, is people with 50% or more in down payments. And that's not your typical millennial buyer, though some millennials have been saving up for a long time and they can do it if they're fairly successful. How do you see the housing sector? David?
Well, I'm as a trend following, momentum oriented investor who respects fundamentals tremendously as much as anybody on this panel. I just respect the market's opinion of the fundamentals more so than my own, certainly. What I'm always looking for are fundamental narratives that just aren't playing out in the market. And so when the consumer was supposed to crash and the rates when rates were taking off and housing was supposed to, this is speaking back last year when housing was supposed to just completely fall off a cliff, and yet home builders just kept outperforming. That to me was the market's way of sniffing out something that was counter to the accepted narrative, which we now know that with rates where they are, nobody's going to sell their house because they don't want to roll up to a 7% mortgage yield. So for me, I like to find those situations where the trends as expressed by the market, which is the market's fundamental view, are saying something that's counter to the narrative, and that's clearly one. And I wouldn't. It's still a decent area of the market as far as I can tell at this point. The other one too was basically when the bear market started in the beginning of 2022. It was, once you can identify that you're in a bear market, obviously the first thing you want to do is hunker down and protect capital. But once you've done that, the next step you want to focus on is trying to find those areas of the market that are doing better than they should be doing given their beta profile. And oftentimes that's the market's way of telling you that this is what leadership is going to look like once this bear market is over. And it's interesting to note that if you look at the relative performance of the industrial sector at the very beginning of 2022, which was when the bear market started, relative performance bottomed right then and pretty much outperformed throughout the entire bear market, particularly if you look at industrials on an equal weighted basis. And that's the market's way of sniffing out superior fundamentals and saying, yes, this is a bear market, but when this turns, this is going to be where you want to be. And now we know, onshoring semiconductors and rebuilding of America, and that's all playing out right now. Now we understand that the fundamental narrative. So that to me is still pretty attractive. And then I also don't want to lose sight of the strength that energy has displayed over the past couple of years in the throes of a bear market, reversing a 10 or so year relative performance downtrend. And it's by far over the past 2 years, it's been the strongest sector in the throes of a bear market. And again, money goes to where it's treated best, and that's always where the best fundamentals are. And so the fact that energy is doing as well as it is, oil above 85 is definitely intriguing to me as well.
And so you tend to think that, fundamental investors will say housing, like energy, has been plagued by a decade of underinvestment, and now it's in very short supply.
Yeah.
But to get back to what you said about industrials, do you think that they could be in the next bull market one of the leadership groups?
I do, and I think if you look at the current leadership of the market, it's almost a who's who of. This is what's kind of perplexing to me. I hear a lot of people say that the quote unquote market has been whistling past the graveyard. We have all these negative macro data points, and yet the market's up 14 or something percent year to date. That I just believe that's patently false. That's not what's actually happening. What's actually happening is 10 stocks have driven the S&P higher, and the average stock is actually down year to date. So the average stock is fully engaged with the very uncertain, volatile macro regime that we're in right now. The average stock is not doing much of anything. The half the market is below where it was at the bottom of the banking crisis. So, and the average stock is still down over 20% from its January 2022 peak. So we're still very much in a bear market, and the market's very much from the bottom up engaged with this bear market that's going on. And you had asked about shorting, like right now at the end of a 20% decline. I'm not too keen on shorting too much, but the last great short setup was of course the digital asset space when it rolled over. That was a situation of just change the names, change the storylines a little bit, and you basically have the .com bubble all over again, including naming rights for stadiums, celebrity endorsements, the smartest money in the room buying it all the way down, all while the market is telling you it's over. So that's probably one of the best shorts we're going to have. We will have seen, could be for a couple of decades, much like the .com bubble. Post that bubble was a great shorting opportunity as well.
Ali or Tom, how did you see Bitcoin as one of the short opportunities?
I spend zero time on that. For me, we're interested in productive assets that generate cash. As it relates back to housing, just to kind of put a bow tie on that, I think you have the cost of, if you just look at the Fed's dot plot, which doesn't really tell you much, but it does tell you that the direction that they believe rates are going, and they're usually they overshoot on both sides, and right now they're overshooting to the upside, but they're still telling you, in spite of their hawkishness, that rates are going to be a lot lower 6 months out, not 6 months out, 9 months out, and then 9 plus 12, 21 months out. And so you're going to see, Fed funds rate at, what is it? Maybe by 3.9 in the next 12 to 15 months. And then even I think as they get up 2.5 years, it's in the twos. So in that environment, demand comes back into housing, but also you have the millennials, again, 82 million. You haven't had a setup like this in residential housing since the early 90s in terms of demand. So it's a push-pull, but I'll tell you, the minute you see mortgage rates come in 50%, that demand's going to be right back. And I think you're also going to see a change in supply of housing where, believe it or not every 33-year-old needs a 4,700 square foot house with a movie theater. It'll be more like Levittown in the 50s, the last boom post World War II, where everyone gets, 1,000, 2,000 square foot house to have a baby, get things started. And there's just not enough supply of that. I think now that with technology, those homes can be built a little further and further out from the city because people don't have to be in every single day. That supply will come on, and that's what that the sector has been telling you with its strength. It's just a DNA thing. I don't chase things up. It's had a huge run. I missed that sector. I talked about it. I thought about it. I did nothing. So I'm not going to chase it after the fact. I'm going to find those things that are leaving the station versus those that have left the station. Similar with energy in 2020, we were very interested. Last December, everyone was calling me, "What do you think about energy?" I said, "I think sold to you." I was interested 2 years ago. Do I like the secular trend? Do I think we're setting up similarly to the early 2000s in terms of emerging markets, in terms of small caps, in terms of value? Yes, I do. But let it take a breather, let it knock all the Johnny-come-latelys out, and then I'll catch the next leg.
Okay, we got a question here from the audience. Could each of you describe the amount of your portfolio's net exposure, long or short, and why, and what would cause you to change it?
I'll jump in. We're running like probably, I don't know, somewhere between 10 and 20. I mean, it's between 10 and 25. It varies by the day, but not by more than a little tiny bit. So we're probably 17 or 18 right now, net long. We don't run net short. We're probably a little less optimistic than the rest of the crowd.
Okay. And Tom or David, do you have a net position exposure?
I'll jump in quick. So we're, as I said earlier, I only short in established bear markets, and as I think I described earlier, we're still in a bear market. We had a shot at terminating the bear market off the October bottom with that large rally that we had leading into the banking crisis. But since that banking crisis, much of the rest of the market is just kind of restored to its old trends, which is back to the bear market environment. So we do have some short exposure on right now, and our overall gross exposure is down from where we would like to see it in a robust bull market. But right now it's probably 25% net long.
Okay.
Yeah, so I'll just say, I mean, one of the things I learned working at Cornwall Capital, and for those of you who don't know or are a little younger, Cornwall was featured in The Big Short. I worked for the guy played by Brad Pitt, who was a lot smarter than Brad Pitt in person, but not quite as handsome, although, I'm sure he would believe that he was. And I wouldn't correct him on that. We express short views when the asymmetry is in our favor. So when we can take a limited amount of capital and have an expected value of 2, 3, 4, 5x, and we express it through long premium with a specific idea. And right now, given the market volatility, given the sell-off in names, given the fact, and I think David aptly pointed out, that most of the market has done nothing this year and on balance is negative, excluding 10 or 12 stocks that have caused the S&P to be up, whatever it is, 13% year to date. So we're more interested in buying what's on sale. Wall Street is the only place when they hold a clearance sale, people run out of the store. And right now there's a lot of stuff on clearance. And I think his point was 50% of the stocks in the S&P 500 are below the banking crisis lows in March. Was that correct? Yeah. And it's slim pickings. So, why would I want to get aggressively short into what is still $3 trillion above trend money supply, an environment where I can find high quality, durable cash flows at massive discounts? So we'll find, and I can express shorts through different views, right? I mean, I can express shorts through having a view on rates. I can express shorts many different ways. So as far as, is there a pound the table short that one could express today that would make a lot of sense on a risk reward basis? And I would say they're more limited than you think, because if you think about the basic things that we would look at, where well above average historic multiple with slowing growth and a downside catalyst, getting those three things in place right now outside 20 stocks. I mean, it was funny, I was looking at the ARM Holdings IPO, and I think when it went out, what was it, 100 times earnings and 25 times sales? I don't know, someone will correct me on that, or it was 100 times sales and 20, whatever it happened to be. But I wouldn't short that. Like, I wouldn't short it because I understand the game. There's been no supply. The ducks are quacking. You feed them, and it's working. So until you start to see a massive amount of supply of new paper, shorting opportunities are going to be very, very discrete and on a one-off basis. And so we have limited. We're really looking at this volatility as opportunity into year end. Managers still positioned too defensively in cash. They've been all year, and I think the risk going into year end, based on sentiment positioning and going into earnings, which earnings for the last 3 quarters have been too pessimistic by 300 basis points. We're probably going to have earnings growth plus 3% this quarter because expectations are negative 20 bips. I wouldn't want to be short into that. So if you can find me something, one that was interesting that we talked about publicly in June, because I was on a TV station that forced me to have 3 picks and 2 pans. And my 2 pans were NVIDIA and Apple, not because they're bad businesses, but at that point, Apple was trading, I think, I don't know what it was, 24 times, 25 times, with earnings growth decelerating to, mid-single digits. And so it was like a 4 or 5 times peg, and as opposed to its historic multiple of 14 times and kind of a euphoria around it, et cetera. So it was priced for perfection. But would I ever short that? Absolutely not. That's like brain damage. And then finally, we would never talk about shorts publicly. I think a lot of lessons have been learned about that over the last 24 months. So I'll leave it at that. It's on a discrete basis. It's when there's massive asymmetry where I can risk maybe 1% of capital for a 3 to 5x EV. And those are few and far between in the current environment, in our view.
Okay, well, fascinating analysis and good food for thought. We are over our time, but I want to thank David and Ali and Tom for taking this time out of their business trip or vacation or whatever and calling in. And we've had a fascinating 55 minutes here. And for the rest of the audience, thanks for being here. And enjoy the rest of your day and come tomorrow because we've got a good show for you then.